Friday. Thanks for coming today. Just a couple quick announcements that I had. With Easter coming, don't forget today we have Good Friday live stream Mass in the Event Center at 3 o'clock today. There will be no Catholic Mass tomorrow because we are live streaming Easter at 9:30 on Sunday. So if you want to attend Mass and then head on into brunch, we hope you join us for that. And the only other thing I had was in your mailboxes from the Wellness Office, you did receive a notice. We are doing a COVID clinic on Monday, May 12th. That's from 9:30 to 3. Please get your form into the Wellness Office no later than Friday, May 2nd, if you wish to receive the vaccine. It's going to be Moderna, and Topps Pharmacy will be here. So please see Lori Gercio or Debbie up in Wellness if you'd like to receive that. Do we have any resident announcements this morning? No? Okay, quiet morning then. So we'll get right into it. I would like to introduce Amy Bard and Kyle Larson. They are both Senior Vice Presidents with Wilmington Trust, here to talk to you about capital perspective.
Great, thanks Allison. I want to thank you all for joining us today. I want to thank you also for inviting us to speak here on this topic. As Allison said, my name is Amy Bard. I'm a Senior Wealth Advisor for Wilmington Trust. Kyle Larson is our Senior Investment Advisor with Wilmington. And just a little background about Wilmington. We are the investment arm of M&T Bank. So we have the pleasure of being behind a strong bank, headquartered here in Buffalo. M&T is now actually the 15th largest commercial bank in the country, so it's nice to have it headquartered here. Wilmington Trust, we were founded about 122 years ago as the DuPont family office for them. So Wilmington is really founded with generational wealth planning, investment management. So that's really kind of where our history comes from. We have the pleasure to work with the folks here at Fox Run, the Finance Committee, managing assets for you all. And with that, we really just wanted to talk about what's going on in the economy today, our capital market perspective going into this year, the administration, the topic of tariffs. So Kyle's really going to walk through a presentation that we share with our clients talking about market and what's going on. We want this open to questions. We're going to talk for about 20 minutes or so, 30 minutes, but just very interactive. I can come around with a microphone or any questions, just feel free to interrupt. So with that, I think I'm going to just pass it to Kyle and he'll walk through the presentation.
Great, thank you, Amy. Kyle Larson, pleasure to be here with everybody. As we get going here, as Amy kind of said, if you have any questions, please feel free to raise your hand and interject anytime. Otherwise, I'll just be up here blabbering around for 20-25 minutes. So, for those of you that are kind of familiar with kind of how financial firms work, every year you kind of put out your capital markets forecast, what you think the coming year might bring. For us, Wilmington Trust, our theme of the year was Chutes and Ladders, and I'm sure many of you are familiar with the game Chutes and Ladders, where you roll the dice and you land on a ladder, projections forward and higher, you land on a chute and you kind of head down lower. That's kind of our metaphor for coming into the year and what the economy might bring, given a lot of question marks with the new administration. There was certainly some telegraph as far as what was on their minds and what they wanted to do and accomplish when they stepped into office. So when we talk about shoots, some of the biggest things was tariffs. That was number one on our list of a shoot that could potentially slow the economy and move us in the wrong direction from a growth perspective, at least in the short term and the interim. On top of that, you had the potential for continuing widening fiscal deficits. We've been running a very wide fiscal deficit here as a country for a while, and we've really ballooned that out with the last administration, going from an average of, call it 3 to 4% up to 7% of annual GDP. which is not a sustainable path. So that creates some longer run issues that as a country we need to really work on addressing, because we've just layered on quite a bit of debt. We've got $9 trillion in US Treasuries that have to be refinanced within the next, I think, 9 months. Not a small number. And you're refinancing from very low interest rates to much higher rates with where we're at today. And that presents even more issues on the fiscal front. You know, we already have about a quarter of our tax revenue paying debt. So there's, you know, this ongoing debate within administrations, government, as to kind of how we resolve that issue. Trump and the administration's coming in and looking to try to pull back spending and take some other measures to maybe, you know, bring manufacturing or bring more business and growth here to the United States. And I think that method of action is certainly causing some disagreements. The ladders, what are the potential upsides that we saw coming into the year? The biggest being, once again, fiscal and monetary policy. So that could be a benefit if we continue to inject money into the economy. We are expecting to maintain the tax cuts from several years ago, which isn't necessarily an addition because it's what we're already experiencing right now. But if we were to allow those tax cuts to lapse, our tax rates would move higher, and that would potentially be a negative for near-term growth. Potentially a positive for longer-term fiscal balances, but a negative for near-term growth. And so what we're trying to do as an economy is trying to balance what's coming in from tax revenue versus what's going out for what we're spending, and do we have the ability to kind of grow in the economy, because as you grow in the economy, you grow the revenue base, depending on your tax structure. So lots of different things that are kind of going into what we're looking at, but essentially what we said is, as an investment firm, there's a lot of question marks going into this. We're looking at elevated valuations in stock markets coming into the year. So we took a little bit of risk off the table within our portfolios, and that kind of brings us to this slide here, where you see kind of everything's right down the middle, neutral, which basically says there's potential for markets to move higher, there's potential for markets to move lower. We don't know what direction things are going to go because we don't know exactly what's going to come out of the administration. And rather than carry a little bit of additional risk within, call it, equity markets, we trimmed back from some of the equity markets and we added to hedge positions and fixed income. Additionally, we rotated out of US large cap, which has done very, very well for the last several years, and moved a little bit more into international markets where relative valuations have been much better. So that's kind of our positioning, and so far that's been the right move. As we've seen, you know, S&P 500 had a 20% sell-off in a matter of a couple weeks. We have recovered some from that, but still a lot of volatility that we're having. And this kind of leads us, based off of the most recent round of tariffs that have been layered on here from Liberation Day. Are you all feeling liberated yet? All right. We are now expecting a mild recession in 2025 this year. You know, really for a variety of different reasons, but a lot of it comes down to the unknown of what policies are going to remain in place and how long they're going to be in place. And it's very difficult for a firm or a business to try to operate their business, especially if they have supply chains from countries that are being affected by tariff policy, to navigate that space when you don't know what the clarity is the next week, the next month, the next year. How do you determine if you want to build a manufacturing facility in Mexico or the US if you don't know what that tariff policy or what the tax policy is going to look like? So it's really leading to a lot of slowdown on the consumer side and also the CapEx side from corporations. So the consumer was already slowing kind of heading into the year. And we were already expecting weaker growth in U.S. markets heading into the year. And now you can see here, based off of you know, these charts, when we're tracking things, contributions to GDP and the Atlanta Fed Now Tracker, which is a pretty widely used forecasting tool for the direction of GDP, is predicting negative 4% GDP growth in the first quarter. Now, it is important to note that the Atlanta Fed Tracker is notoriously volatile and not always correct, and there's always a lot of revisions. So take this with a grain of salt. It doesn't mean that we're going to have negative quarter It's really just kind of a tracking mechanism. There's a lot of volatility in the data that goes into it, but it is kind of seen as a leading indicator. You've seen so far the most recent labor reports that have come out pretty well, pretty good. We're still looking at pretty decent levels of unemployment, but once again, these reports that are coming out, they're backdated, right? So we're not seeing any of the data since tariffs have been implemented. Same for the inflation report that we just got. We're just under 3% now year-over-year inflation. We're trending, we were trending in line with our expectation to get down to roughly that 2.5% level by the end of the year, which is very much in line with the Fed's kind of long-run target. But tariffs are, if you slap a 25% tariff on a good coming in, that's going to increase the price. So you may have a year-over-year increase in inflation, but it's not as concerning from a long-run perspective, or even from a Fed perspective, as to contributing to inflation on an ongoing basis. And that's one of the reasons why you haven't seen the Fed say, yes, we're ready to cut interest rates now based off of tariff policy. Because tariffs are a one-time step up in prices, not an ongoing thing, and that one-time step up in prices is likely to lead to a lower level of demand. Where you get inflation problems on a long-run basis is when prices go up, but the demand and the support to consume more goods is still there, and it leads to prices continuing to go higher. With a weaker consumer, that may not be what we see. So that is one reason why the Fed may not move quite as quickly as the president is hopeful on, and he's voiced that opinion here recently. What we touched on earlier, firms cutting back on hiring CapEx. This is one of those charts that we take a look at from basically polls that not that we do, but that are done from the Federal Reserve, Atlanta, and this is what you're seeing. You're seeing a lot of firms basically indicate that based off of what we're seeing in immigration, corporate tax, regulatory, and trade and tariff, you can see trade and tariff is the biggest block here. It's leading to roughly a 25% cut in hiring, 25% cut in capital spending for many firms. There's a few firms that are looking at increasing expenditures, but you can see the negatives significantly offset the positives. So, obviously with tariffs, some firms, depending on how they're set up, it may benefit them. Other firms are going to be impacted more. One thing that is very important to look at is, well, what is the rate of change within the tariff policies that have been implemented? You can see here, this is the chart of tariffs as an effective tariff rate since the 1800s, and we have been on a steady decline as globalization has increased and comparative economic advantages have basically moved and are allowed, for example, China to manufacture goods for us a lot cheaper than we can here for a variety of different reasons. And tariff, lack of tariffs, creating open trade has allowed countries like the US to purchase those goods at very cheap prices. Well, now you can see at the very bottom, check this out. There we go. Oh, right here, right? So this little spike here was Trump's first presidency, his first term, where you saw this little bump up in tariffs here. At the time, that was seen as pretty significant, but you basically moved from like 2% to 4% in tariffs. Well, after this most recent, we've moved from here, escalated here on March 6th, escalated here on March 4th, up to 24% April 9th tariff levels, last not seen until the 1900s. In a situation where we're importing significantly more goods. That is a massive tax, essentially, on U.S. consumers of goods that you're importing. Now, you most recently rolled back some of those to those that did not retaliate. So that 24% number has moved down to a whopping 20%. Because the fact of the matter is, tariff policy is still implemented on our biggest trade partner, China, where we import not the majority, but a lot of our goods. And so that has created certainly a lot of issues when it comes to trying to operate businesses for those, once again, importing goods, managing supply chains, and trying to get those products to consumers at stable prices. Now, with all that said, where does that leave equity markets? So equity markets coming into the year, in our view, had, you don't typically see 20+% returns in financial markets without some type of reset or pullback or reversion to the mean. And if you take a look at this, forward PE ratio, that's a price to earnings ratio, it's a widely used metric for trying to, as one measuring tool for trying to determine what is the market overpriced or underpriced. And you can see here that average is really somewhere around this 18% longer term. And we had this big spike here right after COVID, and then we have this run up here just recently coming into the year where U.S. equity markets are trading about 22 times forward earnings, which is, historically speaking, very expensive. You're in like the 95th percentile. And once again, that was one of the reasons why we decided, hey, let's pull back a little bit of riskier, things are looking kind of pricey, let's move some to other markets that aren't as expensive. With a 20% pullback in the S&P 500, we've moved from 22% or 22 forward earnings down to about 18 or 19x here. So with a 20% pullback, we've only moved down to above average still. So by no means would we look at the market and say, hey, the market's cheap, even with the 20% pullback. So if we have tariff policy that remains implemented the way it is, expecting a slowdown in the economy, there's certainly a possibility over the next handful of months and quarters that you could see further drawdown in U.S. markets because they are still not cheap. The good news is, what does that mean for our recovery? If we're looking at an expected recession, well, we're looking at what we would think would be a very mild recession, a recession that could easily be averted or altered, once again, based upon policy. Trump could very easily say, we've reached an agreement with China and we're pulling back all of our tariffs tomorrow. That's one of the reasons why it's very difficult as an investment firm to say, you know what, things aren't looking good right now, let's just get out of equities, out of financial markets. Things could look very different tomorrow, just with a tweet, right? So, while we don't want to be overly weighted to risk, we still need to be invested because we don't know what tomorrow will bring. And when we're thinking about, okay, well, if we do find ourselves in a recession, what might that look like? The good news is that, first off, recessions, on average, only last about less than a year. The average median recovery is about 11 months. Coming into the year, financial firms have been in a very good place, especially with profit margins, running at well above their average, 13%. So that indicates that our large cap firms, S&P 500, they have a lot of room to maybe absorb some of the negative tariff policies of higher goods. So they have the ability to absorb some of that rather than passing all of it to the consumers because they have pretty healthy profit margins to start with. And also, when we take a look at how corporations are on the balance sheet, much stronger position balance sheet wise. There's a lot of firms sitting on a lot of cash. The debt that they do have has very low interest rates. And this also applies to many of us as consumers. If you look at the U.S. consumers or U.S. households in aggregate, we are in a very, very much stronger position coming into this situation than we were, coming into the great financial crisis, where basically everybody was over-levered. So when you have a very strong pullback in economic growth, you're over-levered, you've got no safety bucket to kind of move into the next phase, that's a really tough position to be in. That's not where we're at today. We're overall positioned pretty strongly. The economy was operating pretty good. And for those reasons, we think that, yes, there's probably going to be some volatility, there's probably going to be a slowdown in economic output as we kind of figure out what policy is going to be longer term, and as supply chains get reorganized. We don't think that you're going to see car manufacturing come to the U.S. tomorrow, because that's just not possible. We don't think you're going to see a lot of manufacturing come to the U.S. tomorrow, because it just doesn't make sense. But you will see probably some of that on the margin. Quite frankly, some of the tariff policy just doesn't make sense. Why would you put a 46% tariff on Vietnam, who makes our shirts and shoes, for example? Those jobs aren't going to come back to the U.S. So it's more positioning what the president has done than anything to force people to the table to have those discussions, because there are certainly, in our view, probably some instances where tariff policy is not reciprocal, it's not fair on both sides. one example is, auto tariffs within the EU. They're charging us 10% to ship our cars there. We only charge them 2.5% to move their cars here. Why? Is that fair? President doesn't think so. So, when you slap everybody with the tariffs that are going to probably move the world economy into a recession, it brings people to the table. So that's what we're going through right now. And, we'll see what the next 30, 60, 90 days brings. I imagine that we, as a country, as an administration, don't want to willingly push us into a devastating, lasting recession. I would imagine that there's going to be some talks and some negotiations and a little bit of movement when it actually comes to tariff policy that will probably be to the benefit of the U.S., at least in some capacity. Some of the issues that you do bring up, though, from this is how our image and our trusted trade partners may look at us. You've seen, for example, flights and tourism to the U.S. plummet. You've seen Canada in many different fashions trying to find other goods to replace U.S. goods. So there are knock-on effects to the way that we're going about this at the same time, which may have longer lasting effects on our corporations and the business that we do have right now. So one of the things that comes up pretty often in having investment reviews with clients is, what about tech stocks, right? Tech stocks, AI. We've seen massive growth in this space. The S&P 500 as an index, now the top 10 names make up about a third of the index, and most of those top 10 names are technology stocks. And so there's been a lot of question as to, well, this resembles the dot-com crisis, right? When we had internet companies kind of take over the whole market, and then everything collapsed. Different market we're in here today. We don't think it's the same at all. So you can see in 2000, you had about a third of the S&P 500 made up of tech stocks, but they were only contributing about 12% of the earnings of the S&P 500. Today, well, this was as of last week, 2 weeks ago, tech has sold off a lot more, so it's probably down about 32% now, but you see the earnings contribution is about 32%. So this brings you down to the quality of the companies that are in that space. So yes, while there are still a higher level of concentration, we'll call it Meta, Nvidia, Google, Facebook, well, Meta, Netflix, the earnings that they're driving validates why they're that big and where they are, and there's not nearly the same potential for a fallout or a bubble per se. This isn't a bubble. Maybe they're a little bit value a little bit higher than they should be. I think there could be an argument there, but there's not going to be a bottom dropout. Not for that reason. Perspective is everything. We have been here before. We don't know what the next driver of a recession or a market correction or a bear market will be, but we know they're going to happen. On average, they happen every 6 to 7 years. And you can see here just kind of the timeline of different events and how long it took to kind of recover and move forward. And I think the biggest thing is we find a way to move forward. We certainly have some things we got to figure out, and it's probably going to take us a little bit of time to figure that out as a country and as corporate firms. Once again, look to maybe change their business models. But you figure it out. And that's the one thing about our economy, the U.S. economy, is how resilient it is in the ability for our companies to move and to make changes that are needed to adjust. And we'll figure that out. It might be rocky. I think we're expecting markets to be rocky. And this is once again why, as investment advisors, we always refer to having a plan, a long-term financial plan in place that can kind of keep us on a steady path. We know volatility is going to happen. We know market pullbacks are going to happen. Is our plan still intact when those happen? Are we still on the right path? We can't let emotions and behavioral aspects derail us in our financial plan by making rash decisions, like, for example, liquidating, because the hardest part is when you get back in. I've never seen it work where somebody sells and they're able to buy the bottom. Just doesn't happen. At least not in my experience. If you did, good job. But industries that are most vulnerable to tariffs. So just a quick update here. Some of the industries that are most resilient, you can see, lower value implies weaker pricing power. So at the top, healthcare providers, they have fairly strong pricing power because their prices are kind of built in on a contractual basis, on a go-forward basis, which is good for the short term. But as we saw the last couple of years, it hurt them a little bit when prices went up really high. But you can see here, what are the sectors with the highest direct import share of inputs? Some of those that will be most impacted by tariffs: automobiles, aerospace, defense, oil and gas. So these are sectors that are especially susceptible to maybe some negative market movements from tariff impact policies. All right, I spoke for a long time. Anybody got questions? Gotta be something out there. Yes?
Are you concerned about the $37 trillion we have in debt to other countries at this point?
Absolutely. Yeah, we have, I think it's roughly 120% debt to GDP now. Once again, not a sustainable path. And you see the president taking that very seriously right now. That's what the DOGE committee is about, right? We're going in, we're trying to cut government spending. When you look at the CBO projections, which try to project how different policy might impact our budget and our fiscal balances over the years, they one of the issues within how they kind of calculate things is they almost never assume that costs get cut. So projections don't always look good when certain policies are kind of brought to be voted upon. We collect a lot of revenue in taxes as a country, and that revenue has been pretty standard and pretty consistent on a GDP level, somewhere around a third, 30-some percent or something. Maybe it's not that. I think that number's off. Don't quote me on that. But what we do have is a spending problem, the fact that we're spending more than we take in, right? And as we've seen, that spending is largely what got us in an inflation problem at the same time. I mean, there were some other issues that contributed to that. War in Ukraine, and we can all discuss what maybe led to that. But that affected supply chains. But the money that we handed out as a country, as a government, was probably $1 to $2 trillion too much. And that's a lot of money. And when that much money is floating around, it doesn't, it gets spent. And that's what leads to inflation going up higher, on top of the issues that we already have from the supply chain standpoint. And once again, I think I touched on it earlier, we're currently running a 7% annual fiscal deficit when a sustainable or theoretically sustainable level is somewhere around 3. And that's still a deficit, right? But the theory is that the economy also grows roughly around that same path. So as the economy grows, your tax revenue grows, and it keeps up with the spending number. It doesn't keep up with 7%. That's a massive difference. And that's a massive difference that you're running in a period where you're not in a recession, you're still in growth, and you're not in a wartime scenario where you're paying to cover a war, for example. And that's something that we're, as an administration, you're seeing a lot of steps that are being taken to try to correct this, maybe correct's not the right word, but to try to make an effect on the spending side of things. And, that's certainly going to have, I think, some negative consequences to it at the same time. But the fact of the matter is we spend too much. If you try to raise taxes, especially on those in the lower end of the spectrum, that's not going to work out very well. So how do you do it? You got to find ways to try to grow your economy a little bit more without injecting monetary stimulus, and that's not a super easy thing to do. So that's why we're pretty positive on what we could do within the efficiency side of things through AI, for example, which might help improve efficiency and growth, which doesn't take as much capital or labor force to boost economic growth. Did I answer that? Okay. I saw your question first, and I'll get to you next.
Are you concerned at all that the DOGE cuts seem a little haphazard? And what do you think about what effects they could have? As an example, I'm thinking if Medicaid gets cut, hospitals are probably gonna see their use of emergency rooms double. Comments?
Yeah, I mean, there's definitely some concern about that. I'm sure there's a whole lot of people that are a lot smarter or well-educated on that topic than I am. You gotta start somewhere, you gotta cut something, and anytime you cut something, someone's gonna be upset because that's money that was going in their pocket. Social services like that, I think is a little bit different than, call it what's happening with Harvard and, the educational system, who have multi-billion-dollar endowments and foundations that are still getting government money. I think there's a lot of arguments that can be had for what's right or what's wrong. And there's a lot of secondary and tertiary impacts from every decision that's made. And I don't think I'm qualified enough on the subject and what's happening to say whether or not a certain cut or a certain job cut is beneficial or negative for longer-term growth. We gotta cut somewhere. It's not gonna be good, it's not gonna feel good, but we gotta cut somewhere.
I was wondering, could you comment on how the United States comparatively measures up to other countries in terms of financial status in the World Bank? Where do we fit in this? Are we really on the downside, or are other countries having the same issues?
Yeah, so in terms of like our balance sheet, for example, the amount of debt that we have, we've definitely gotten to the point where we're in a worse position than other countries. Japan's a little worse, they're probably the most comparative. The EU was worse, they're no longer quite as bad, but they're still, I think they're below 100% debt to GDP, where we're well above now at this point. And if we push this number much higher, it's going to put us on a completely unsustainable path, because once again, a quarter of our tax revenue right now just goes to servicing the debt. And if we continue to run deficits where we're issuing more and more debt, we're just compounding that problem. And at some point it comes crashing down. I don't think we're anywhere near that point, but we have to take steps now before it becomes irreversible.
And Kyle, just to add to that, could you maybe just talk a little bit about how we're also positioning a little more towards international equities and how that kind of is playing into this?
Yeah, I touched on that, I think, earlier at the beginning of the slide. So as we did move slightly into international equities on the margin, just because of the relative valuation compared to the U.S. markets, for example. With that said, I don't think it's a firm view that we expect international equities to outperform U.S. equities over a very long basis. They still have growth issues as a economy. Their growth rate is somewhere around 1%, ours is averaging, call it 2.5. And with an aging population that they have, I don't think that it's going to be something that they kind of run away within financial markets from the U.S. It's a very different economy. On a relative basis, risk-return basis, it makes sense to add on the margin, but it's not an all-in thing or anything like that.
What countries hold most of our debt right now?
That's a good question. I don't know the exact specifics. I know, obviously, one that comes up a lot is China, right? I think they hold approximately 2% of our outstanding debt, which isn't that much. But if they decided that they didn't want to hold that debt anymore and they just liquidated or sold it on the open markets, it would cause interest rates to spike tremendously, which would be very bad for not just us, but the world, especially in a time where we're, once again, having to roll over about $9 trillion in refinance debt. If they did that at the same time that we're trying to refinance or reissue a whole lot more money, that would hurt our fiscal position a lot worse than it already is. At the same time, it would hurt China because it would weaken their currency at the same time. So we do have this kind of symbiotic relationship where a tit for tat hurts both sides, right? So the tariff policy that we're implementing on China hurts us. It also hurts them. Who's willing to take more pain?
That's 2%.
2%.
Where's the rest of it?
The U.S. citizens hold most of it. I think it's somewhere around 80%. Don't quote me on those numbers. It could be wrong.
Just looked it up, it says 8.9% for total U.S. national debt.
Say that again, sorry?
8.9% of the total U.S. national debt. Is that possible? That's what it says.
80.9% of the
18.
8.9. I want to say maybe it's 8.8. Is it 8.9 of the outstanding held by international, or is it 8.9 of the total?
Of the total U.S. national debt.
Like I said, don't quote me.
A lot.
It's a lot. Any way you cut it, it's a lot, right? And if they were to once again liquidate that or sell it to the open market, it would have severe financial impacts. I think that's the biggest thing.
$786.6 billion in the U.S. Treasury
786 out of 37
bonds.
trillion. I don't have a calculator, man. It's still a lot.
Any other questions? Okay, well, thank you, Amy. Thank you, Kyle. Give them a round of applause.
One other thing. So the portfolio that we manage is essentially your money, right? It helps pay for the sustainability of Fox Run as an organization, your living and your care and everything. I don't know if you're familiar with the investment guidelines, but New York State, Reg 140 has very strict investment guidelines on how we invest money and what we can buy and the amount of risk we can take within the portfolio. So just to kind of give you some perspective, the maximum equity exposure we can have in the portfolio is only about 30%. The rest is fixed income. So the portfolio is very, very conservative overall. So if we do have a very, very ugly financial market, the sustainability of what we have here, what your livelihoods and everything is not at risk. And I think that's important. And if you were concerned about that, don't be, because it is very conservatively invested in, and that's by design, right? So the regulations are put in place to make sure that nobody's trying to get too aggressive to try to grow things too much and then have something negative happen that affects everybody's lives.
Do the state regulations allow you to work with options?
They do not. No options, no futures, no derivative products at all, no private markets, only credit, quality, credit graded fixed income. A certain portion of the portfolio, the vast majority of the portfolio has to be dividend payers. That way you're not investing in speculative stocks, for example. So there's a lot of regulation that goes into it. You can't have concentrated positions, so you can't have too much invested in one stock. So there's a lot of checks and balances.
Okay,
All right.
thank you.
Thank you, everybody.
Thank you.
Thank you for coming.
Yeah, my pleasure.
Very good.